CAPM shows the relationship between the expected return of an asset and its risk in equilibrium. The key words here are expected return and risk in equilibrium. CAPM describes the expected return, not the actual return. On the other hand, the single index model shows the actual returns and then derive the expected return. We will explore what it means by risk in equilibrium later on when we get to the market price of risk. When we apply the Markowitz model and some simplifying assumptions about the use of the model and the market, we get CAPM. All investors have an identical input list and optimize their portfolio by Markowitz optimization process. So they select the same weight for each risky asset and hold the same optimal risky portfolio. In the simple world of CAPM, the optimal risky portfolio is the market portfolio. In this scenario, the market portfolio held by all investors is based on the common input list. So it incorporates all relevant information about the universe of securities. This means investors can skip the trouble of doing security analysis and obtain an efficient portfolio simply by holding the market portfolio. The market portfolio is the value-weighted portfolio of all assets in the investable universe. The weight on stock I is the market value of stock I divided by the total market value of all stocks. The CAL is in fact the CML. If investors hold a common risky portfolio identical to the market portfolio, they would not say no if all stocks in the market were replaced with the shares of a single mutual fund holding that market portfolio. This is known as the mutual fund theorem. There are two ways to test a model. The first way is a normative test that's based on the model assumptions. Assumptions are robust if model predictions are not highly sensitive to violation of the assumptions. The second way is positive test based on model predictions. Now let's look at the CAPM assumptions first. CAPM assumptions fall under two broad categories: individual behavior and market structure. The first assumption, investors are rational, mean variance optimizer using Markowitz model. They don't care about what the return distribution looks like or the correlation of returns with inflation. The second assumption, the planning horizon is a single period. Longer periods would result in extra market risk. For example, a declining interest rate would reduce returns. Investors would build up assets that hedge against interest rate risk. The third assumption, investors have identical input list, so they have homogeneous expectation. That's why they arrive at the same optimal risky portfolio we mentioned earlier. It's not unreasonable when all information is publicly available. The next three assumptions are on market structure. The fourth assumption, all assets are publicly held and traded so that investors arrive at the identical input list. The fifth assumption, no taxes, otherwise different investors have different after-tax optimum portfolio. The last one, no transaction cost, investors can trade freely. CAPM has two implications. First, the market portfolio is efficient. Second, the risk premium on a risky asset is proportional to its beta. By using the single index model, first, investor can eliminate firm-specific risk by holding a portfolio with as many stocks as possible which is the market portfolio. Second, investor would relentlessly buy up positive alpha stocks and short sell negative alpha stocks and drive the alpha value to zero. As a result, the expected risk premium of stock I is proportional to market risk premium. From Chapter 8, we see the weight of a stock in an active portfolio is zero if its alpha is zero. If the alpha of every stock is zero, then there's zero weight on the active portfolio and 100% is invested in passive market portfolio. That's why the optimal risky portfolio is the market portfolio.